Welcome back. Today we're looking at a great submission, an analysis report on Intel's recent massive stock surge.
Yeah, that plus 8.65% day, it really caught everyone's attention.
It did, and this report does a sharp job recapping the move to $43.47 and asking if $50 is next. It sets up the bull-bear case really well.
It does, and I like that it jumps right into institutional activity. But, as I was reading it, I felt there's this analytical gap that we really need to address right up front.
Okay, so you're seeing that tension, the tension between the, let's call it short-term technical euphoria and the long-term financial reality of the company.
Exactly that. The stock is flying, but the valuation is, well, it's screaming for caution.
So the material needs to more rigorously address the massive disparity between the current technical momentum and the fundamental valuation risks presented.
That's the topic sentence right there.
Right. So from what I'm getting, the report says the stock is moving on pure technical strength, breaking that $40 resistance level.
Mm-hmm.
But it also, to its credit, acknowledges the elephant in the room, a GAAP PE ratio of over 4,000.
4,000? I mean, it's basically saying the price is running on nothing but fumes and future hopes, a massive liability.
And that's where you see the opportunity?
That's the spot. The report flags this huge valuation problem, but then it subordinates it almost immediately to the strong technicals, like closing near the high for the day.
Okay.
And it just relies on this generic phrase, future expectations. That creates a gap. There's no clear quantified bridge between the price action we're seeing today and the fundamentals you'd need to justify it.
I see what you're getting at. The technicals tell you what happened, but the fundamentals have to explain the conviction. Why would a long-term holder believe this move to 50 is sustainable?
Precisely. If the market is putting a 4,000 PE on this thing, we have a duty in the analysis to define what kind of performance that actually implies.
So the suggestion is to integrate that financial reality check directly into the risk-reward part of the analysis.
Yes, quantify it. We need to tell the investor, with hard numbers, what level of success Pat Gilsinger's turnaround plan needs to hit to earn this price.
Okay, that's actionable. But how do you do that? I mean, a semiconductor turnaround is incredibly complex. You have the 18A process, huge capital expenditures. How do you boil that down to a single metric?
You have to give the momentum a fundamental anchor. So instead of just saying the GAAP EPS is low at 90 cents,
you calculate what it needs to be.
You calculate the necessary earnings recovery. What does the 2026 EPS have to be to bring the forward PE down to something, sane, a historical average or at least a sector average?
Okay, so you work backwards from a more reasonable PE ratio. Let's say, 25 times earnings? Still aggressive for a mature company, but it reflects growth.
25 is a good number to start with. The point is, the analyst needs to do that math. What is the actual dollar amount of EPS Intel has to generate in, say, 2026 or 2027 to justify $50 a share at a 25x multiple?
That's a great point, because it completely shifts the focus. It's no longer just about observing the breakout. It's about giving the investor an economic benchmark to measure all future earnings against.
And that's the real value add. You could use that number as the benchmark for the whole turnaround thesis. The report could say something like, a move to $50 implies the market is pricing in an EPS of X by 2026.
Which then lets you say, this sets an incredibly high bar for their foundry execution and their cost cutting.
Exactly. It moves from a vague risk to a quantified specific risk. It stops the investor from worrying about the scary 4,000 PE number and gets them focused on the real financial milestones that matter. It makes the whole piece feel more authoritative.
Got it. Okay, let's move on. Let's talk about the catalyst for that 8.65% surge. The material pins it on a technical breakout and a general sentiment shift.
And, that's fine as far as it goes. The technicals are part of it. But to really elevate this analysis, the specific trigger for that huge move needs more detail.
I agree. Things like 18A progress and cost reduction, those are the long-term drivers. They're the bull case. But they don't explain the timing. Why did the stock jump 8.5% that day? Not the day before, not the week after.
That's the core of the weakness right there. The report is missing that definitive time-specific piece of news that explains why big money suddenly piled in. This wasn't a slow creep up. The report itself calls it an explosion.
And explosions have an ignition source?
They do. So the goal is to find that immediate psychological spark. The suggestion for improvement is to research and integrate the most concrete news item from the 24 to 48 hours before the surge. That's what will sharpen the explanation.
Right, finding the why now. You mentioned a few ways an analyst could go about finding that spark. Where do you start?
It's sort of a hierarchy of probability. You start with the most obvious source, analyst coverage. Did a major bank issue a big upgrade, from neutral to overweight, or a big price target hike? That's often the green light for institutions to buy.
And that's usually easy to find.
Usually. But if that doesn't turn up anything,
Then what?
then you pivot to the market mechanics. Look at options expiration. Did the move happen on a big options expiry day? Because a break of a key level can force dealers to hedge like crazy, and that can create this kind of upward spiral.
Ah, the gamma squeeze effect.
Could be. The point is, forced hedging is a mechanical driver that can blow a move way out of proportion to the actual news. Or look at short interest. Was there a report showing shorts were vulnerable?
That would explain the volume in the short covering the report mentions. And what was the third avenue?
Capital rotation. You have to look at the competitors. Did something bad happen for AMD or Nvidia that day? Some unexpected delay, some geopolitical news that made Intel suddenly look like the safer value recovery play?
Right, so money flowed out of X and into Intel for reason Y. That's a much stronger, more specific narrative than just sentiment improved.
It is. It shows the analyst has done the deep dive research to really justify calling it an explosion instead of just, reporting the price.
Okay, that makes perfect sense. Let's shift to the final section, the action plan for investors. I think it's good that it tries to offer something for both traders and long-term holders.
It's a thoughtful idea, absolutely. But the action plan section would benefit from a much more distinct separation of the advice for those two groups.
Because right now, it sort of blends them together. You've got this high-level talk about a 2026 recovery right next to these very specific short-term trading levels like $44 and $42.
And that's the weakness. It ends up being less useful for both. The long-term holder might see the talk about a $44 resistance level and think it's just day trading noise.
And the short-term trader, conversely, doesn't really care about EPS requirements 3 years from now.
Not at all. The advice just isn't tailored to the time frame of the person reading it.
So how do we fix that? I mean, the suggestion seems pretty clear.
It's straightforward. You just create two clearly separate subsections. One is for the trader, and it's all about immediate momentum. The other is for the long-term investor, and it connects directly back to the fundamental evidence we talked about earlier.
Okay, I like that separation. But how do you make sure the trading section doesn't feel completely disconnected from the rest of the analysis?
You frame it properly. You say the reason these technical levels matter so much is because of the high volatility driven by all that fundamental uncertainty. So for traders, the advice is tactical. Here's the resistance on the way to 50. Here are your support levels at 42 and 40 if the momentum fails. Pure price action.
Manage the momentum. Simple. And for the long-term section, how do you make that robustly fundamental?
There, you shift the mindset completely away from daily prices. You use the metrics we developed. In the first critique, that required EPS number, the CapEx returns. You create a checklist of future-oriented targets.
So instead of telling them where to sell, you're telling them what to watch for in the next few earnings calls to justify holding.
Exactly. It becomes proactive monitoring, not reactive trading. You could write something like, for long-term holders, this rally is encouraging, but to justify holding, you must see tangible progress on the 18A ramp and improvements in free cash flow in the next earnings report.
So you're turning the long-term focus away from a technical price floor and toward a checklist of fundamental performance. It gives them a real strategic framework.
And it gives the entire report more utility for its entire audience. It turns the technical data into real advice for traders and the fundamental data into a strategic roadmap for investors.
This has been really productive. It's a strong report to begin with, and we've landed on 3, I think, very clear opportunities to make it even better.
Yeah, it's all about making it more authoritative. So first, quantify the fundamental expectations needed to justify that technical price move. Get past that abstract 4,000 PE.
Second, sharpen the catalyst. Find the specific, timely evidence for why that 8.65% surge happened on that exact day.
And finally, split that action plan into 2 distinct, robust sections. Ground the long-term advice in measurable financials, not just price levels.
These are definitely high-level changes, but I think implementing them really transforms this report from a great summary into a powerful piece of analysis.
I agree. The core understanding is clearly there.